Hi, we're going to walk through some problems for Chapter 9 on current liabilities. So liability, of course, we owe the money to someone, and current means it's due and payable within a year. So the first example, exercise 9-1, the following items appear on the balance sheet of a company with a 1-year operating cycle. Identify the proper classification of each item as follows. C, if it's a current liability, and again, that means it's due and payable within a year. L, if it is a long-term liability, so it's due and payable in more than 1 year. And N, if it is not a liability. So number 1, notes payable due in 13 to 24 months. That would be long-term liability. Notes payable due in 6 to 11 months. That would be a current liability. Notes payable matures in 5 years. Long-term liability. Current portion of long-term debt, so that would be long-term debt that goes more than 1 year, but the current portion is the amount due in the next 12 months, so that would be a current liability. Notes payable due in 120 days, current liability. Federal unemployment taxes payable, those are going to be current liability. Accounts receivable, N, that is not a liability, accounts receivable is an asset. Sales tax payable, current liability. Salaries payable, current liability. And wages payable, current liability. The next exercise, quick study 9-4, Keisha Company borrows $160,000 cash on November 7th of the current year by signing a 90-day, 8%, $160,000 note. So we're going to compute the accrued interest payable on December 31st, and then prepare the journal entries. So the first journal entry is going to be for the issuance of the note, then the amount of the interest due on December 31st. So this is the amount of interest from November 7th through December 31st, and then we're going to pay the note on its due date, which is in February. So if we scroll down, we will see we have the answers right here. So we're going to walk through them. So again, computation of the interest payable at December 31st. So you would calculate the number of days from the date of the note, which is November 7th, to the end of the year, 54 days. To calculate the amount of interest, you have the amount, $160,000, times the rate of 8%, times 54 divided by 360. So that equals $1,920 of interest. So this amount of interest is for the current year. Since we have incurred the expense, we have to accrue it. So for our journal entries, the first one is the issuance. So we are receiving cash of $160,000. So we're going to debit cash and we're going to credit the liability notes payable for $160,000. So this will be the entry on November 7th when we issue the note. The next journal entry is for accruing the interest from November 7th to December 31st that we just calculated. So we're going to debit interest expense and we're going to credit interest payable. We are not paying the interest yet. We're just recognizing that we have a liability. And then the last journal entry, when we actually pay the note on the due date, which is February 5th, we're going to have some interest expense. Here's the calculation. This would be for the total amount of interest for 90 days. So the 1920 pertained to the previous year as recorded here. So the remainder of the $3,200 is interest expense this year. We're going to debit the liability because we're satisfying the liability, and we're going to credit cash for the entire amount. That's for $163,200. So we're paying back the note, plus we're paying the interest in total that we owe. The last exercise is Quick Study 9-14. The payroll records of Speedy Software show the following information about Marcia Gottschalk, an employee, for the weekly pay period ending September 30th. Gottschalk is single and claims 1 allowance. Compute her Social Security tax, we're going to use 6.2%. Her Medicare tax at 1.45%. We're going to calculate her federal income tax withholding. She has state income tax of 1%, and then we're going to calculate the net pay. So her gross earnings is $740. It gives us cumulative earnings from previous pay periods. We're not going to do anything with this. This is just telling us that she has not met any of the limits for Social Security. So to calculate her pay, we have gross pay, and then we're going to have the deductions to determine her net pay. Remember, net pay is the amount that she's going to take home or the amount that goes into her account. So we're going to calculate Social Security tax. We're going to take $740 times the 6.2% to get $45.88. For Medicare tax, we're going to take $740 times the 1.45%, and that gives us $10.73. To calculate her federal withholding, we're going to click on the exhibit that's given in the problem above. We know her gross earnings are $740, and we're told that she has one withholding allowance. So we're going to look at the column for one, $740, and we're going to select the $96 for the amount that is going to be withheld. Right here. We're going to calculate the state income tax deduction. $740 times 1% is $740. We add up all of the deductions, subtract them from the gross pay, and we end up with the net pay.